Neal Brincefield, and I'm going to be doing the cash flow allocation buckets talk. This is a talk that you would use at the end of a protection meeting, perhaps, or maybe more likely at the beginning of a strategy meeting for an accumulation-oriented client. Okay, Mr. Client, before we dive into today's agenda and really talk about strategy recommendations, let's back up for just a second and have a conceptual discussion about something that we call cash flow allocation. So we want to think about what happens when you go out and earn a living and you generate a gross income. Every time you earn a dollar, it always goes to one of two places. Do you know what those two places are? Those two places are this. It either goes towards expenses or it goes towards asset building. Sort of, it either leaves your world and is consumed, or do you save it somewhere to be consumed later, to be consumed on college tuition down the road, or to be consumed on a retirement lifestyle later on in retirement. We can further categorize expenses as basically being one of four things. It's going to be taxes, it's going to be debt, it's going to be insurance costs, or it's going to be money that's spent on lifestyle. Gas, groceries, clothes, tuition, that sort of thing. So goal number one when it comes to making the highest and best use of your income, when it comes to this cash flow consideration, is we want to draw this line in the sand. Think of this as sort of the fence that stands between these two different destinations for your money. And goal number one is we want to minimize the amount of money going towards expenses wherever possible so that we can keep more money on the asset building side of the fence. We want you to be efficient in that manner wherever possible. Second consideration is when we do build assets and we're able to save money here, we want to make sure that that money goes towards the best place. And we've identified a few different typical destinations for where those asset building dollars go. So as we find that those savings dollars, there are really two broad categories, two broad buckets that we could use to save those dollars for the future. One is a short-term bucket, and the other is a long-term bucket. And the way we really categorize things in one or the other is based on the types of qualities they have. So think back to our 15 rules and our rules for assets. Basically, we're dividing those rules here, and we're finding that in the short-term bucket, typically a vehicle that we use in this area is going to give us minimal risk, think safety, and it's going to give us liquidity. When it comes to the long-term bucket, we're going to get a higher rate of return, and we're going to get tax advantages. So short-term, think checking account, savings account, CDs, money market account. We really don't get a great return. We really don't get any tax advantages to speak of, but it's highly safe. In some cases, it's federally insured, and it's highly liquid. We can get our hands on those funds really any day of the week without any sort of penalty or restriction. When it comes to the long-term bucket, we're talking about things like a mutual fund, things like an investment portfolio, an IRA or 401k or Roth IRA, things that give us the prospect of a higher rate of return, but absolutely what comes with that is some risk. We have some sort of a tax advantage, whether it's a tax deferral or tax-free growth or preferred tax treatment in the form of capital gains. There's some sort of a tax advantage there. So the question is, where should that money go? What are sort of the rules around that? One of the things that we know is that the short-term bucket really needs to be filled to a point where, at an absolute minimum, you have 3 to 6 months of expenses saved. But that, again, is the absolute minimum in our mind, that you should have that amount of short-term capital. Ideally, it would be more like a year's worth of income that you would have access to in some form of short-term capital, some sort of liquid state, because that's going to allow you to be more efficient over time. It's going to minimize your need to create additional expenses from your cash flow and potentially become less and less efficient over time. An example would be having to use a credit card to replace the air conditioner when it breaks down, as opposed to just being able to access your savings that we set aside for that very purpose. And then we want to make sure that when we finally do put money in the long-term bucket, that we're putting it in the right place. Okay, so right now what you're doing that we want to really examine today, right now, with your gross income, one of the expenses we've identified are some 1099 taxes that are being paid on investments and some insurance costs that are being spent on term. So there's a fair amount of money going there, and that looks like right now it's about $3,500 a year in expenses that we're going to track here in this scenario. And then in terms of asset building, we see that you're saving about $15,000 a year in total assets. And right now, all of that money is going into this long-term bucket, into your taxable investment portfolio. So what we're going to do next is just take a look at, on the living balance sheet, how this plays out. Sort of, let's take a look, set of assumptions and get a sense of what the future might hold. What would be the long-term impact of making these types of cash flow allocation decisions? Okay.